Well, hello, family. The Muscadine Mafia convenes for yet another meeting, and we have allowed the Hello Ladies scream
Hello, ladies.
to sit at the table with us for this most important event. Hope you all are doing well as we get an update from the family. All right, so Stephen, and hopefully he's in here. Stephen brought up something the other day. Yeah, Stephen's in here the other day. So Stephen said, "Hey, Bob, what if instead of paying $500 to do the put debit spread, because that's what the put debit spread costs if you do it in the e-minis?" He said, "How about we put on a couple tranches of the Sweet Bobby hedge?" And to me, I was like, that just sounds genius to me. Because remember, I told you that it takes three Sweet Bobby hedges to fully hedge your 111. So you can't really buy that much. But what if we use the money that we were going to do? Now, if you're in micros, you'll probably need to do it in the micros. If you're doing, you wouldn't want to spend $500 on your hedge if you're doing a micro 111, but we're talking the e-minis now. So I wanted to analyze that, and I analyzed it yesterday and spent some time, and I'll go through it again with you guys. So let's pretend that we're going to do the 111 all by itself, right? So let's do the 111 all by itself. So we'll go to trade. We'll go to 126 days, and let's put in a 111. And let's see. Do I need the whole 111 or do I need the, let me think a minute here. Let's just do this first. Let's do the 4850 would be our short put. All right, let's do the 4900. 4900 will be our short put and make that into one. So we will analyze that trade. Okay. So there he is. Now let's go and pretend we were going to put in the put debit spread. Put debit spread though really doesn't matter that much, I don't think. What's that mean? There we go. Put debit spread would be the 25% probability being in the money. So it'd be the 5450, 5400s. What is wrong with my thing? 5450s, 5400s. My platform's messing up on me. 5450s, 5400s, 5450s, 5400s. There we go, for about $10. Let's make that 4, 3, 2, 1, and let's analyze that trade. Okay, so this is the 111, and let's just see what it says here. It says that you'd have a $15,000 loss. This is without volatility. Let's make sure. Let's see. Let's do this today's date. Go to today, and let's do this. Go to today. I was playing with it a lot. So basically, it says you'd have an $18,000 loss without volatility, but with volatility, look at this. Waka waka. You've got a $42,000 loss in the event that the market went down 20% and volatility went up from whatever it is now to 54%. All right. So from 15% to 54%. Ouch. That's kind of what hurt us the other day is this volatility. It wasn't the price move down, it was the volatility. So Stephen said, "Hey Bob, what if you were to say instead of paying the 500, because let's double check this. Isn't that what a put debit spread is? If you go confirm and send, $516 for that." He said, let's do the Sweet Bobby hedge. So if we were to go into the same expiration, 126, and we go down to the $3, see if we've got $100 wide strikes. Now here's the problem: is we don't have the correct strikes per se. So this is going to be a little more expensive than 250 if we're putting it in the same expiration. I kind of like to put them in the same expiration to compare them, right? Because you'd want this on for about as long as you'd want your thing on. So theoretically, we'd be going to the 2800 but we don't have 50 wide strikes. So let's do the 2950s. Let's do 3 of those. Or 6 of those. Because we're going to do 2 tranches. You just got to keep in mind it's going to be a little more expensive. 6 and 10, right? So this says that this is going to cost us $669. Now remember, it'd be closer to, you know, 550 or so if the strikes were $3, but we're just going with what we got here. Okay. So let's say the 610, let's analyze this trade. And let's change this to ES because I've got my little markers in. All right. So let's take the put debit spread off. And now let's look at the naked put and a 610, right? Naked put and a 610. This is going to look significantly better, okay? Significantly better. Now, if we go down to the 20% off, look at this, y'all. Look at that. $5,164 loss. That is amazing. Compared to $42,591. That's pretty darn good, y'all. I like that a lot. Now, that means though that we're going to give away some of that grind down protection and what's more important. But I just wanted to show y'all that hey man, this is really good because remember the ratio was if we do 3 of these, you should be fully hedged to the downside. Let's see if that's still the case. 13, 14, 15. Yeah, see there? You're fully hedged, 14,130. Now let's go back to 6 and 9 or 6 and 10. Now, you got to keep in mind though, that with this, your protection is going to weaken as the days go by. So if you go from 8/16 to 9/16, then your protection is your 13,000. Let's go back to today's date. Go to today, 13,000. Your protection is 5,000. So you're going to lose $8,000 worth of protection, but still, that's kind of good. Stephen, what do you think about this now that you brought this up? Isn't the SBH loan supposed to be below the short? Yes. Okay, I got it right. Okay, good. Yeah, you never know with me. Y'all got to stay on me because I can mess it up in a heartbeat. But I kind of like that. Kind of like that.
Yeah, 5K is a lot more manageable than 40.
Yeah.
And that's what we're all worried about is, you know, the account blowout, the Black Monday sort of situation.
Yeah. So Stephen, I think I give you a thumbs up on that. I think that's a great idea. So if you are more worried about the what if you buy a $5 put with the 500? Well, we could look at that. What expiration, Schwaz, you want to put it in? Same expiration?
Yes, the same.
Okay, let's look at that. So if we're going to buy a $5 put, now you're looking at a $5 put. Your dog had it. That would be this one. And so if we bought one of those, let's see, how many would we got to be to buy $500 worth of those? Let's see. So if we buy that, that's $254. So we could buy 2 of those. All right. So buy 2 of those, and that would be closer to $500. Okay, buy 2 of those. Now let's analyze that. Analyze trade. All right, so let me make sure I got everything together here. Let's go back to ES where I've got my little price slices. And let's look at -1 and this. All right, so this still not as good, is it?
No.
Negative 16,000 if you bought the 2 puts compared to, I don't know about you, Stephen, but I wish I'd have had a ton of these on the other day. It would have made a difference, wouldn't it? I like this. But I don't know that I necessarily have to change my plan to do this because my plan already says I can do 3 5s. But I think that I can just do these when I do my naked puts. I think that's exactly what I could do. Let's go ahead and do this. So I'll give you the stamp of approval. Anyone else got any comments on this at all? God, do I wish I had these on the other day. It's not the grind down that hurts. I can handle the grind down. I mean, if I have to roll my positions in a grind down, I can roll my positions good, but it's this black swan event that really takes us down. And I think this gives you a great deal of protection. And then if you've got the campaign going too of the black swan hedge, hey, we're really good. You keep campaigning it otherwise, and then this way looks really, really good. Let's see what our theta and all that kind of stuff is. So our delta is 426. Our theta is 560. Y'all kind of remember that, 560 on my theta. Should be similar though. If we do this, it may be a little higher. It is a little higher, isn't it? My theta is 2587 with that. So, you know, you gimmies and gotchas, I guess. Hold on, make sure I got everything right here. Yeah, that's the vertical back spread. So it's going to take your theta down, but at least you got some protection in there. Yeah, I would definitely throw some of these on, I think. I don't like that my theta is affected that much. So 2587. And if we do it with the back ratio spread, goes down to 560. Eee. But let's see what the profit is. Let's go over here and see what the ultimate profit is. Let's just go expiration 1. So let's see, with the foot debit spread, let's see what our ultimate profit would be. Our tail profit over here. We're going to make $1,400 if we don't go into the trap. Right, I'm going to make $1,400. Let's look at the other thing. We do the the back ratio. We're going to make $1,300. Okay, I can take that. You want to know what the protection is after 90 days? Yeah, let's do that. So let's go back in. So the tail profit, up tail profit, is not much difference at all. You're still going to get the 1,300 all the way down to your break even. Well, till there anyway. So let's see. You want to know the protection after 90 days. So let's go 816. We have, let's go back to vol steps. 4, 10. So we said after 30 days, it goes from 4,000 negative to 13,000. No, 10,000. Okay. Make sure that's my thing. No, here it is. Sorry, here it is. 13,000. Here it is. 13,000. And after 60 days, 10, 16. 20,000, right? And this will be 90 days, 11/16, which will be about 11/15, I guess. 11/15 is 25,000. Compared with $27,000 after 90 days with the other one. Still pretty good though. Still pretty good. Anyone got any thoughts or anything else you'd like me to run on this before we let y'all go for the weekend? But I think this is kind of cool. Really cool. All right. So always hear about selling the short from the PDS. Yeah. Now, the thing is, that can get real expensive quick, but yeah, you could do it. You know, depending on where you're at, but in a catastrophe, some people did that and did just fine. Yeah, they did get pricey on 8.5 for sure. All right, guys, good session. Appreciate all you and the Muscadine Mafia, and I will see y'all Monday.